Tackle today, Matt and Mark Justice from Tackle Trading, bringing you all the charts, the news, all of the tidbits so that you can stay informed on what's going on in every corner of the market in a very concise manner. Matt, unemployment report comes out today. This was circle event type for traders everywhere. We expected volatility. Numbers came in a little soft. The price action would have you believe that it is the absolute apocalypse and that nobody's ever had a job before. Severe downward pressure as we look for the next support level. But Matt, let's go look at those technical charts. Uh, let's go look at those technical charts before we get into the numbers.
Well, it's kind of which one do you want to do first
Yeah.
for the whole shut thing? Like, do you want to talk about the downward movement in price, or do you want to talk about the causation for the downward movement in price? Most people want to just understand, why are we down here today, and why are we down fairly aggressively here today? Well, obviously, labor market data came out here today, and when you're talking about the labor market data, very, very quickly, we did have labor market data come in at an official miss, but we are dealing with a little bit of a mixed report. A beat on our average hourly earnings. That's a little bit of an inflationary kicker. Unemployment report actually came down from the 4.3 down to 4.2. The expectation was 4.2, and you had a miss on the actual numbers themselves. And so you had a mixed report, but a mixed report isn't good enough for this environment that where the market is a little bit concerned. And when you're looking at this from an intraday perspective, on the overnight hours, you were actually kind of just kind of hovering in right there, a little bit of an upward movement in price on that actual labor market data. And then when the cash open came out, it just got absolutely rejected there. When you're looking at on the futures contract here, you can see it a little bit more clearly. The market actually starts, right here at about 5:30, right when the report comes out, starts gobbling up, gets right into that 200-day on the 15-minute chart. That's right when the cash open occurred. And then there has just not been the cash opens have been weak this week. There's no doubt about that. And when you do see the cash opens be weak this week, we saw a weak cash open on Tuesday with the big red candle on Tuesday. We saw a weak cash open on Friday with the labor market data coming in. When you see those weaknesses on the cash open, you're definitely going to want to see that change, because that is showing you that nobody's seeing something on the overnight action that they'd like, that the international markets are trading basically in line with the US markets. And as the US markets go down, the international markets go down that lead into the US markets. And it's this little bit of this rhythm in the market right now that you don't want to fight against. And so you're going to want to see that slow down. Absolutely, you're going to want to see that slow down in any bouts of volatility. And we are certainly going through a bout of volatility here. In any fight against volatility, you're going to lose when you fight volatility. And so you want to see volatility subside. So what's important here, in my estimation, is waiting on proper catalyst and proper pattern development. And the most important thing in these scenarios, when you are pulling back in the market, is to identify those catalysts of where that support could build. Now, we talked about this earlier this week on Tuesday. When you violated 555, where was it going to come down into on the SPY? Well, when you violate short-term support, you typically come down to the next level of support. As we saw earlier this week, when you broke the high base, what did you do? You came down and you found that 50-period moving average right around that 550 level. On labor market day, when you broke 550, what did you do? You went down and you found that next level of support right around that 20 weekly, which is right around 540. And so when you're looking at the market right now, realize this: you got support at 540. That's right where the market currently is. And it is a really important support level to hold. That's right where the 20 weekly is. That's also right where a pivot point is on the daily chart as well. That would be kind of that level that you really want to see hold. And you really want to see it hold, not just for the current condition, but if 540 holds and we start working back up, you will start seeing this as a continuation pattern against the overall marketplace.
Isn't that funny? It's like, it feels like it's such severe downward pressure, but if 540 holds, this is a higher low.
If
Like,
540 holds, you're going to see this as an increasing support level against the previous V-shaped recovery, and you're going to see it from a long-term perspective as a cup and handle formation. And that's down the road a little bit, right? You never catch the falling knife, you let it drop, and after it drops, you let it slow down, and then when it starts going back up and confirms, that's when you have something there. And so right now, we're sitting at support. We need to see a doji. We need to see this slow down. We need to see pattern development here.
yeah, no, and the technical battle, because we've gotten a lot of Jackson Hole unemployment report. We've gotten a lot of information into the market in recent weeks. Now it really is a technical battle, and whether that forms at 540 or whether it forms at a lower level, right? You don't know. Eventually, it forms. It always does, right?
But yeah, it
Know,
always does. The question is, at what level does the selling stop? Right?
yes,
Because you don't want to fight the selling. When we went through this in April, and this is the worst week since we had April. Okay. And so remember, the worst week in that April pullback was that big red candle, a very similar big red candle to what we have this week. And where did it stop? It stopped on the 20 weekly, and it had a really good move off that. That scenario can happen. Is it a likely scenario? It's a different technical pattern than we were dealing with, because you got the double top. So I don't expect it to run back up into resistance and then just run, because again, you do have a different technical pattern, but you got a similar level against support, and you got a similar candlestick, and you had a turnaround story the next week. The last time we went through this, right before the current V-shaped recovery, it violated that level as we tested that level before it did what? Before it found a different support. And when you're looking at the candle here, you're like, that's no man's land. That's no man's land. Well, that's when you're looking at a singular time frame. When you come back out to the daily chart, the S&P, when you look at the futures, actually kissed against the 200-day moving average. And so the market's going to find support. It's just a matter of analyzing where is that support, and then quite frankly having the patience of pattern development and allowing patterns to develop where you're not fighting the volatility, but you're picking it up when the rest of the market is as well.
yeah, no, and once again, if I'm looking at for a support level that builds where the bulls earn it, that's not what we had on the V shape. I think we're paying for some of those sins. And that requires patience, right? Because whether that forms at 540 or 530 or 520 or wherever it forms, all right, wherever it forms, realize that, hey, that is likely to provide a really good opportunity. But you have to wait, you have to make it earn it. You have to make it earn it.
And just to provide a little bit of context to what you're saying here, paying for a little bit of our sins in terms of the no support level being built in that V-shaped recovery. Yep. Well, against that V-shaped recovery, we are currently at a 38% retracement, just to give a little bit of context to the pullback against that upward movement in price.
All right. So let's get to that news today, Matt, that sparked this, the unemployment report. And this was a circle the event on the calendar in advance. Ever since Jay Powell emphasized labor numerous times at Jackson Hole, saying, listen, we're going to be sensitive to labor. We're going to be sensitive to labor. We're going to be sensitive to labor. Well, the unemployment report came out today. That is arguably the most important report that will be released this month. Came in a little soft versus expectations, 142,000 jobs added versus 165. The average came down after a couple revisions down to about 116. So economy still adding jobs, just not at the robust pace that it had been doing. Unemployment rate, and this is the SAM rule that got so much press, untriggered today, going down to 4.2%. Won't get nearly as much press.
You don't think we'll get that on the Twitter today?
Yeah, no, you won't get us like, oh my gosh, the SAM rule does it.
4 billion tweets on, hey, let's talk about the SAM rule today.
Yeah, and so and the odds of a 50 basis point cut jumped on the number. You know, Matt, when I look at this data, I think I see some good, I see some bad. I don't see apocalypse. I wouldn't be surprised if the Fed cuts 50 basis points. But I see some good and some bad. I don't see anything that has me overly concerned that, oh my gosh, a recession is upon us, which if sometimes the price action, if that's all you look at, what it can feel like on days like today. What was your take on the labor market data today?
Yeah, mixed report here today, and
Yeah, that's simple, right? A mixed
yeah,
report.
it's a mixed report here today. Obviously, the labor market is softening with the revisions of the last couple months, bringing it down to the average of 116. That's obviously a softening labor condition. Unemployment rate fell to 4.2, which is a little bit of a good reprieve. Hourly earnings actually increased. I'll tell you right now, Mark, if this was a report in April of this year, we would be concerned about the inflationary side of the equation with the average hourly earnings beating and the labor missing there. But different environment. In general, I would say it's a mixed report.
Well, and Matt, if this report happens 6 months from now, there will be no market reaction to it. Like type situation.
There's two things happening here. Number one, on a mixed report, why are we down so aggressively here? Number one, it's because the Fed told us to be extremely sensitive to incoming labor market data. That's number one. Number two, the market is currently in a moment of playing a little bit of chicken with the Fed here. And what I mean by that is the market wants a 0.50 cut. And so I think the market is saying, give us a 0.50 cut here. And so I think there's a little bit of the market pushing the Fed around a little bit going on this week as well. And so let's let this play out more than anything, because we do have a mixed report. We do have an overall negative market this week. We do have a market that is sensitive, to incoming data. And so let's let that play out a little bit in my estimation.
Yeah, no, it's one of those situations that I think the volatility heading into the report spurred more volatility. I don't think it is. This feels more like technical and intraday algorithmic driven than actually investors saying, "Oh, fundamentally, let me make it." This feels very momentum technical intraday action. I'm sure we will talk about that on the podcast in depth this weekend. But in the midst of the macro, always individual stock news. What do you got for us today?
Yeah, we got three stocks in the news here today. Not a big stocks in the news day, but we got Broadcom, Unipath reporting earnings, and Supermicrochip is getting another downgrade here by JP Morgan from overweight down to neutral. From a Broadcom perspective, they just had a good old fashioned lowering of guidance, and that was really kind of the kicker when you're talking about Broadcom and their earnings report here today. When you're looking at Unipath actually came in line from a reporting perspective. Not a good beat, not a good miss, not an increase in guidance, not a decrease in guidance, just a pretty standard report coming out of Unipath as well. And then when you're looking at Supermicrochip Computer, they've obviously been in the news recently. They got obviously a lot of eyes on them with the revision of their earnings, or the potential revision of their earnings. And then Supermicrochip Computer came out and said, we're not going to revise our earnings. And then you get a couple downgrades in the environment. And so in general, you got a lowering of guidance on Broadcom, in line on Unipath on their earnings release, and then a downgrade on Supermicrochip Computer. When you're looking at that from a technical perspective, Broadcom gapped down on that lowering of guidance, and now you're talking about a 200-day moving average test against Broadcom, very similar to what we went through last time. Kind of sniffed that 200-day before it had a little bit of that upward movement of price. Very similar reactions, quite frankly, to what the broad market is doing itself. But Broadcom right around that 200-day moving average as of right now. When you're looking at Unipath here, Unipath actually tried to gap up on their inline reporting, and I would say like they guided towards the top end of the range, so you would see that as a positive. It gapped up, but then when the cash open came out, what did it do? It sold off right with the marketplace itself. Was a positive reaction to their overall report. It also found to the penny the 20 weekly on top of the price action, which tells me exactly what you need to see here. If you're looking at Unipath, you need to see a breakout of 14. Good pocket, a good reversal playing out on Unipath. Just got a little bit carried away with that gap up into resistance. Tough market cash open. Obviously, Unipath got caught up into that. but a good reversal playing out on Unipath. Keep an eye on that one. And then on Super Microchip Computer, very quickly, just has not stopped selling from their from all the way back a couple months ago with the violation of 800. From that point on, it just has not had any chance here and continues to sell down. Not a good look with the violation of that 400. It does not have support till you start working into the low 300s. This is a really tough look for Super Microchip Computer here.
Yeah, listen, let's go to the dollar, Matt, as we go to the commodity area, global markets. This was such a terrible unemployment report spelling the apocalypse that the dollar is basically unchanged, actually up a little bit.
I would say the dollar's the one that has it right here today.
Yeah, no, because this was a mixed report. Seriously, like 4 months from now, 5 months from now, when it's not, oh my gosh, it doesn't change anything.
If
And
the
the dollar
Fed didn't tell us to be laser focused about it, about labor, and if we were not right in front of a 0.25 versus a 0.5 interest rate cut, we would be doging in the stock market today.
It is that simple. But dollar just basically unchanged because it was a mixed report. Currencies have a tendency of telling the truth. And as such, not a terrible surprise that you see gold basically hanging out, doing what it's been doing for a few weeks now, right? Pretty benign price action, even on interday. A little bit of move here or there, but pretty benign. Still eyeing that breakout level, aren't we?
Yeah, I am still eyeing that breakout level. And remember, a couple weeks ago when I did the data in the newsletter that we put out every single week, and we're going to put out the latest tackle trading newsletter today as well. So definitely get ready to check that out. We talked about exactly what occurs historically in rate cutting cycles, because oftentimes people, when they start hearing about a rate cutting cycle, they get excited about the potential of lower interest rates. But rate cutting cycles have a mixed historical edge when it comes to the stock market itself. Out of the last 6 rate cutting cycles, 3 had a tendency to actually shake it off and go up. 3 actually saw big volatility to the downside. When you're talking about that same data and gold has an edge in rate cutting cycles, and it is not a close edge in rate cutting cycles. And so with the rate cutting cycle typically having an edge on gold because of the impact to the dollar, and now you're talking about a pretty clean technical breakout above 2560, you got to like gold on a breakout in my estimation.
Yeah, no, absolutely. Listen, we're going to break it all down in the newsletter today. We release our tackle trading newsletter every Friday. Not a bad time. This newsletter is a behemoth monster of goodness. Not a bad time to sign up for that 15-day free trial. Go to tackletrading.com and you get to see the newsletter, the traders report, everything we're releasing this weekend. But have a fantastic weekend, everyone.